Welcome to today's webinar, which we will discuss the issue of the revised conceptual framework by the IASB and the subsequent issue of ITC 39 by the IASB, which deals with the implementation of the global revised conceptual framework in Australia. What results from the IASB consultative process is highly likely to be one of the most significant changes to the Australian financial reporting framework since the adoption of IFRS back in 2005. The discussion during this webinar will assist with your familiarisation of the proposals which aim to shape the future of financial reporting in Australia. As can be seen from the initial poll results, there is a mix of people preparing both general purpose financial statements and special purpose financial statements. And I suspect some people will be preparing both general purpose and special purpose for different parts of their groups. So we have a wide variety of interests today. My name is Michael Voot and I will be your host for today's webinar. I'm a director in our Department of Professional Practice, a group that helps clients and KPMG staff with interpreting and applying IFRS and other Australian financial reporting requirements. Joining me on this webinar is Julie Locke and Joe Rinarelli, who are both senior members of our Department of Professional Practice. The IASB issued the revised conceptual framework for financial reporting in March 2018. In response to be consistent with the IASB's strategy and the Financial Reporting Council's directive in Australia, and to allow Australian companies to remain IFRS compliant, the framework needs to be applied in Australia. In the course of considering applying the revised conceptual framework, the IASB has identified an inconsistency in the definition of reporting entity in the framework and the widely used and understood Australian reporting entity concept set out in Statement of Accounting Concepts SAC 1. Australia is unique in that our current reporting entity concept allows entities to self-assess their reporting status and therefore the content of their financial reports and compliance with accounting standards. Globally, there has been much criticism of this. This has drawn attention to the more emotionally charged issue of special purpose financial statements. After discussing this issue with Treasury for a number of years, the IASB has decided it's time to act and will use the catalyst of the revised framework to address the Australian reporting entity concept, a concept that was created approximately 30 years ago. In response to the IASB framework, the IASB have issued ITC 39. It's a consultation paper discussing the application of the IASB's framework and addressing or resolving the reporting entity and special purpose financial statements issues as identified by the IASB. ITC 39 sets out the reasons behind the IASB's decision to make a move on special purpose at this particular time. Over the course of the next 45 minutes, we will explore the above issues and discuss the current IASB proposals contained in the consultation paper. So let's consider the IASB's revised conceptual framework first. The framework sets out the fundamental concepts of financial reporting that guide the IASB in developing IFRS standards. It helps to ensure that standards are conceptually consistent and that similar transactions are treated the same way, hopefully providing useful information for investors and others. The framework also assists companies in developing accounting policies when no IFRS standards apply to a particular transaction. And it helps stakeholders more broadly to understand the standards. We expect it will be rare for companies to use the framework directly when selecting their accounting policies, in the absence of a specific requirement in the standards. However, when companies need to do this, they will need to apply the change retrospectively. Importantly, the framework does not override the requirements of any standards. If there is a conflict or an inconsistency between the framework and a standard, the requirements of the standard take precedence. The IASB has decided not to automatically change existing standards as a result of the changes it has made to the framework. Instead, the IASB will expose any proposed amendments to an existing standard just as it would with any other proposed amendment. So nothing will change in the short term. As mentioned earlier, it was released, the revised conceptual framework was released in March 2018. The IASB will start using the revised concept immediately, and arguably it already has, in developing the revenue and leases standards. Companies will only use it from 2020. The new framework has an introduction, 8 chapters and a glossary. 5 of the chapters are either new or have been substantially revised. Those being the reporting entity, the elements of financial statements, recognition and derecognition, measurement and presentation and disclosure. The revised framework is about 3 times the length of the version it replaces. For further details of the IASB's revised conceptual framework, there is an excellent project summary contained on the IASB external website. The IASB's original framework was published in 1989. In 2005, the IASB started working with the US FASB to develop a common framework. This resulted in 2 chapters being published, the objective of general purpose financial reporting and the qualitative characteristics of useful financial information. And these were incorporated in 2010. As with most projects with the FASB, the IASB, after 2010, decided to continue its work alone. And in May, it published an exposure draft proposing the new chapters, which has resulted in the framework being issued in March of this year. The previous framework was incomplete and needed improvement. In particular, it was identified as a priority by stakeholders as part of the 2011 agenda consultation. There were gaps that needed to be filled. For example, guidance on measurement, presentation and disclosure, including guidance on the use of profit and loss and other comprehensive income. There was also a need to update some guidance, for example, the definition of liabilities and assets. And finally, there was a need to clarify some guidance. Once again, for example, the role of measurement uncertainty and the role of stewardship prudence in financial reporting. So what's changed, been updated or been clarified? The revised conceptual framework is more comprehensive than the old one. However, most of the concepts are not new. It codifies the thinking that, as I mentioned earlier, has been adopted in recent standards like IFRS 15 revenue and IFRS 16 leases. The granularity of the guidance differs. Some chapters only highlight a list of choices for the IASB to apply when setting standards, for example, measurement and presentation and disclosure. Conversely, other chapters provide more direction on how the IASB should make those choices, for example, assets and liabilities. The distinction between liabilities and equity has been removed from the revised conceptual framework. It will be dealt with in a separate project. The main changes to the framework principles have implications for how and when assets and liabilities are recognised and derecognised in the financial statements. The main areas of change. The new framework describes 2 measurement bases, historical cost and current value. The framework asserts that both bases can provide predictive and confirmatory value to users, but one might be more useful than the other under different circumstances. As such, the framework does not favour one measurement base over the other. In relation to presentation and disclosure, it includes high-level concepts about how information should be presented and disclosed, and this covers other comprehensive income. The IASB is currently working on a disclosure initiative, which is a collection of projects aimed at improving disclosure in financial reporting. In the disclosure initiative, the IASB will consider developing new concepts for the framework to provide additional guidance on presentation and disclosure. Derecognition. The new framework states that derecognition should aim to present faithfully both any assets and liabilities retained after the transaction and the change in the assets and liabilities as a result of the transaction. The recognition criteria no longer include a probability or reliable measurement threshold. Instead, uncertainty about the existence of an asset or liability or a low probability of a flow of economic benefits are noted as circumstances when recognition of a particular asset or liability might not provide relevant information. KPMG has identified the following three areas as having a potential significant impact. New bundles of rights approach to assets. So a physical object can be sliced and diced from an accounting perspective. For example, in some circumstances, a company would book as an asset a right to use an aircraft rather than the aircraft itself. The challenge here will be determining to what extent an asset can be split into different rights and the impact on recognition and measurement. The new practical approach to recognising liabilities. So the old recognition thresholds are gone. A liability will be recognised if a company has no practical ability to avoid it. This may bring some liabilities on balance sheet earlier than at present. However, if there is uncertainty over existence and measurement, or a low probability of outflows, then this may result in no or delayed recognition in some cases. The focus on whether the entity has the practical ability to avoid a transfer of economic resources as opposed to whether it has a theoretical right to avoid the transfer like we currently use in IASB 137, the provision standard, highlights the change here. The challenge will be determining which future actions and costs a company has no practical ability to avoid. Neither management's intention or the likelihood of transfers affects the practical ability assessment. And the third one, the new control-based approach to derecognition. A company will take an asset off balance sheet when it loses control over part of it. The focus will no longer be on the transfer of risks and rewards. And we can see this coming through in the new revenue standard. The challenge will be determining what to do if a company retains some rights after the transfer. I will now hand over to Joe, who will take you through how the IASB is seeking to address the two key Australian application issues, being the definition of a reporting entity and the Australian reporting entity concept.
Thanks, Michael, for the introduction to the IASB Conceptual Framework. We will first look at applying the reporting entity definition in Australia, which is the main issue identified by the IASB in applying the new framework. The new reporting entity framework's definition of the reporting entity is an entity that is required or chooses to prepare financial statements. A reporting entity can be a single entity or a portion of an entity, or can comprise more than one entity. A reporting entity is not necessarily a legal entity. This definition is quite broad, and based on this definition, an entity that is required to prepare financial statements would be considered a reporting entity and therefore required to prepare general purpose financial statements. This new definition of reporting entity is around the boundary of economic activities for an entity that is required to prepare or elects to prepare financial statements. It will result in entities reporting as a single entity, a portion of an entity, or a consolidated entity. This change will impact all entities that currently lodge statutory accounts by legislation, for instance, under the Corporations Act or AC&C, as it would require the preparation of general purpose financial statements for these entities. This new definition is a departure from the current concept of a reporting entity under the current Australian concept, where a reporting entity is defined by reference to the existence of users who are dependent on general purpose financial reports for information for making and evaluating resource allocation decisions. This definition was introduced in Australia in August 1990 and has survived in its current form for approximately 30 years. The Australian definition of a reporting entity has resulted in the current Australian-specific concept of special purpose financial statements. The key differences between the new definition is a what versus the old definition of who. The IASB's definition uses a boundary approach which determines what is reported, whereas the AASB's definition uses a user-based approach which determines who needs general purpose information. So the question you all must be thinking is, why does it matter if there are different definitions of a reporting entity? The Australian Accounting Standards Board is required to adopt the new framework to ensure it continues to meet the Financial Reporting Council's directives, and to do it requires it to ensure that entities that need to comply with IFRS are able to do so. Adopting the new framework for entities that are publicly accountable. This means that the AASB is generally required to adopt the framework, and in doing so, all entities currently preparing special purpose financial statements will be required to prepare general purpose financial statements. This would be a significant change from the current approach. In addition, the other reason the AASB is looking to address this inconsistency is that by kicking the problem down the road, accounting standards will reference two different definitions. This could result in misinterpretation, the wrong application of AASBs, or non-compliance with IFRS, and may be too difficult to resolve in the future. Before we look into the approach the AASB is taking on this, let's look at the special purpose financial statements further and understand what problem exists with special purpose financial statements as they stand today. Research performed on behalf of the AASB in 2014 indicated that approximately 55 to 60% of entities lodged special purpose accounts with ASIC, including approximately 80% of large proprietary companies. The AASB has questioned whether this was the intention when Australian reporting entity concept was developed. Take, for instance, the following example, where two similar companies in the same industry both have thousands of customers, revenue in the range of $180 to $200 million each, 100 employees, and are both foreign-owned companies with one shareholder. One prepares general purpose financial statements, reduced disclosure, and the other prepares special purpose financial statements. Why? As illustrated in this example, we can get two different conclusions in assessing whether an entity has users and is therefore required to prepare general purpose financial statements under the current AASB definition. You can see that this approach is very judgmental, indicating its subjective nature. This compares to the objective approach under the new framework, where an entity required to prepare financial statements will prepare general purpose financial statements. So why bother? The AASB has indicated that by looking to address the special purpose reporting issue identified in the new reporting entity definition, the following wider benefits are expected. Continued IFRS compliance in line with the AASB's mission, alignment to the ATO general purpose reporting requirements for globally significant entities. This may also reduce the additional regulatory costs for entities that are currently lodging two different sets of financial statements, one general purpose set to the ATO and a special purpose set to ASIC. Increase the level of trust and transparency of corporate Australia. We want to specifically highlight here that the benefits of incorporation and registration is specific to limited liability, and note that those with those benefits comes additional requirements to other external parties. Reduce the risk to directors and preparers in assessing whether they are reporting or non-reporting entities. This also includes the costs that are associated with assessing whether an entity is a general or special purpose entity in the first place. This also benefits regulators in the current climate by levelling the playing field and reducing the number of questions they may have on special purpose financial information. It could also have the flow-on impact of reducing specific regulations to force general purpose financial statements for some industries, for instance, the aged care industry. Conversely, the costs transitioning to the new standard are expected to stem from additional complexity in applying general purpose financial statements, and this is specifically the costs that are associated with consolidation and/or equity accounting, where it has not been previously applied, increased regulatory burden and one-off transition costs to go to general purpose financial statements, which we would expect. This would be particularly the case where ASIC's minimum reporting requirements in RG 85 aren't currently being applied. RG 85 requires all recognition and measurement requirements of Australian accounting standards be applied, along with certain minimum disclosures, such as cash flow statements. The Australian Reporting Entity Framework gives preparers an ability to self-assess what type of financial reporting is required. Currently, Australian accounting standards specify only minimum disclosures for statutory special purpose financial statements. Other regulators have provided additional guidance indicating that there is minimum recognition and measurement requirements for special purpose financial statements also. The IASB has had preliminary discussions with users, and these discussions have indicated their needs for information about liquidity, solvency, cash flows, commitments and contingencies that are currently not being provided in most special purpose financial statements. Retaining the current framework without modification would not be viewed by the IASB as being consistent with its objectives. The IASB also cited the following two facts: the findings of the INCAT Australia Proprietary Limited versus ASIC High Court case, which implies that users should be given the widest possible interpretation and not restrict users to shareholders, potential shareholders, creditors, potential creditors, and customers. It also implies that a large proprietary company is inherently economically significant because it has been classified by the Corporations Act that way. The case provides insight into what regulators generally expect from entities required to publicly report, that is, general purpose financial statements. Data aggregators, for example credit rating agencies, also collect financial statement information for all entities lodging with ASIC, and their clients use this information to facilitate credit risk assessments. The IASB has evaluated that the removal of the self-assessment should ideally be done through legislative change. However, the number of regulators required to make the necessary changes means that this would take significant time and effort to achieve, as indicated by past experience. Therefore, the IASB is proposing options to solve the special purpose financial statement issue without legislative amendment, given the issue is currently part of the Australian Accounting Standards Framework. Overall, the benefits of the reporting entities concept by taking out the subjectivity will go a long way in levelling the playing field and improving trust in corporate Australia by providing consistent, comparable and transparent financial reporting. These benefits will outweigh the one-off cost of transition and the increased burden for a small number of organisations. So lastly, what's off the table? So the large proprietary test in the Corporations Act 2001 or any other objective threshold in legislation, the IASB has stated in the past that the ideal solution to the special purpose issue is for regulators to amend legislation to ensure that for those entities that are required to publicly lodge financial statements, they should be preparing general purpose financial statements. The current approach by the IASB to solving the special purpose issue doesn't address the size thresholds around proprietary companies, which have been the same for over 10 years. Unfortunately, making this change is not easy in the current environment. It is also worth noting that the IASB has been working with Treasury for a number of years to resolve the special purpose issue where large companies are preparing special purpose accounts. Unfortunately, they have not been able to make any headway to address this, and accordingly are using this as an opportunity to address the elephant in the room: large corporate entities determining there are no users, in line with our earlier example. Another area that isn't being touched is grandfathered for proprietary companies that utilise lodgement relief under the Corporations Act. And finally, trusts and other entities that are not currently required by legislation, deeds of constitution, or otherwise to prepare financial statements in accordance with Australian accounting standards. I will now pass you on to Julie to discuss the proposals on the changes to the special purpose framework.
Thanks, Joe. Well, now that Joe has told us what is not changing, let's understand what is actually being proposed by the IASB and what is proposed to change. The IASB has considered in some depth the adoption of the revised framework in Australia and has landed on a preferred approach which it feels will resolve the identified concerns. And this is the two-phased approach. And as the name suggests, there are two phases to the solution. Phase one. Well, phase one is to maintain two conceptual frameworks in the short term. Publicly accountable for-profit entities and those that voluntarily seek to report compliance with IFRS, that is those entities preparing general purpose Tier 1 financial statements, will apply the new IASB framework, that including the new definition of reporting entity. Now, this is not expected to have any negative or unforeseen impacts for this class of entity, and in fact will maintain the ability to claim IFRS compliance, which, as we've heard, is a cornerstone of the AASB strategy and the Financial Reporting Council's directive. And it will also be consistent with the IASB timeline for application of the new conceptual framework internationally. All other entities would stay with the status quo in the short term. So those who prepare general purpose Tier 2 financial statements or special purpose financial statements will keep applying the existing framework, the one that includes the Australian reporting entity concept. So submissions for phase one are sought by the 9th of August, and on the assumption that no adverse consequences are brought to light from the 3-month consultation, the ITC will essentially be viewed as an exposure draft, and the AASB will seek to finalise the implementation of this phase as a matter of priority, for the prime reason that we previously mentioned, the ongoing ability for entities preparing general purpose Tier 1 financial statements to be able to claim IFRS compliance. So phase 2. And this is where you're going to need to concentrate. Phase 2 will involve a longer process and require extensive consultation, research and analysis to achieve a longer-term better outcome. From Joe's earlier explanations, this is the phase that is seeking to resolve those two identified issues. So let's understand what is being proposed. The obvious first outcome is that only one conceptual framework will exist, the new conceptual framework. And this means that the new definition of reporting entity will be applied to all entities required to report in accordance with Australian accounting standards. As you would expect, there will be no change for publicly accountable for-profit entities and those that voluntarily seek to report compliance with IFRS, those that are preparing general purpose Tier 1 financial statements. They will just continue on the course that they began under phase 1. But what about entities that are not publicly accountable? The AASB has proposed two alternatives for general purpose Tier 2, which it has termed reduced disclosure requirements, RDR, and specified disclosure requirements, SDR. So as the names suggest, these are disclosure differentiated options. Tier 2 would, under both alternatives, require compliance with full recognition and measurement aspects of Australian accounting standards. Both of the alternatives would also require consolidation and equity accounting where applicable. So let me just emphasise that only one of RDR or SDR will exist, not both. The consultation period will decide which of the two alternatives to take forward to finalisation. So let's understand the differences between this RDR and SDR a bit more. General Purpose Reduced Disclosure, RDR, is the existing General Purpose Tier 2 set out in Australian Accounting Standard 1053, which deals with the application of tiers of Australian accounting standards. And this has reduced disclosures from each of the Australian accounting standards. General Purpose SDR, the specified disclosures, is a new Tier 2 being proposed, which has disclosures from some specified accounting standards. The AASB is proposing that the full disclosures from the specified accounting standards be provided. That is, there be no reducing for the specified, no reducing of disclosures for the specified standards. The proposed specified disclosures relate to the standards and areas set out on the right-hand side of the slide. So the first 5 standards will be familiar to those of you who prepare special purpose financial statements, as they are the minimum 5 disclosure standards for non-reporting entities that currently exist. The other 4 areas of proposed disclosures, which would be AASB 124, 15, 136 and 112, for those of you familiar with the accounting standard numbers for the areas, have been determined from previous research and consultation that the AASB has performed in the recent past on some of its other complementary projects. So as Joe mentioned, essentially users have indicated that their need is for information around liquidity, solvency, cash flows and contingencies. Impairments of assets and revenues are areas in the preparation of financial statements that are constantly picked up by ASIC as being poorly complied with, and are areas involving some of the more significant judgments and estimates by preparers which have the potential to impact both the financial position and the performance of entities. The current environment of tax transparency and tax legislation general purpose financial statement measure is where the income taxes standard gets drawn in. And I find it difficult to challenge in today's trust deficit at times why related party transactions would not be of interest to users of the financial statements. So general purpose SDR therefore seeks to strike a balance between the additional burden of preparing financial statements above the current special purpose financial statement benchmark and the needs of users of financial statements by those entities required to lodge financial statements with the regulator in accordance with Australian accounting standards. And I use those words with emphasis. So as Joe clarified at the end of his discussion, entities not required by legislation or otherwise to prepare financial statements in accordance with Australian accounting standards, such as perhaps trusts or small associations, small companies and the like, will be able to continue to prepare special purpose financial statements if it's permissible under their constitutional documents. So as I mentioned, the invitation to comment is the beginning of the process for Phase 2. The IASB wants to hear from all of us. It is committed to achieving a longer-term, better outcome to where financial reporting currently is at. It is genuinely interested in our views. Is there a preference for RDR or SDR for Tier 2? So again, whilst IASB has proposed 2 tiers of reporting, it's not averse to consider additional tiers that use an objective measure should there be a sound rationale behind such a proposal. It is also prepared to provide practical and, if necessary, generous transitional relief for entities that end up moving from special purpose to general purpose or between tiers, particularly where consolidation or equity accounting has not been historically applied. The IASB wants to understand if this is a significant issue or not, and also wants to understand if there are other areas that it has not identified where transitional relief is required and is seeking specific feedback on this aspect. So once submissions on Phase 2 have been received, the IASB will move to issue an exposure draft to effect the implementation of Phase 2. Whether in general purpose RDR form, SDR form, or something quite different that arises from this initial consultation and the research and analysis that will occur concurrently. Submissions for Phase 2 are due by the 9th of November, and with due process, this will mean that Phase 2 will only be practically implemented from around 2021 onwards. So before we move into a time of feedback from you, I also wanted to mention that the IASB did consider 4 other options, all of which are set out and debated in the ITC. And I'll leave you to read the detail and reasons for dismissing each of the other 4 options at a later time. Also, the IASB did revisit the option of applying IFRS for SMEs as an alternative, dismissing it for much the same reasons as when we adopted the tiers of reporting in Australia. So as a reminder, IFRS for SMEs moves away from full recognition and measurement, which is not a desirable outcome in the Australian context. And this is supported by the fact that 75% of non-disclosing entities lodging financial statements with ASIC already comply with recognition and measurement requirements.
As mentioned at the start, I think this is one of the most important changes to the Australian Financial Reporting Framework since the adoption of IFRS in 2005. I would encourage you to take the time to familiarise yourself with the proposals and use the opportunity to help shape the future of financial reporting in Australia. You will be most affected if you are required to prepare and lodge a financial report with a regulator that complies with Australian accounting standards. But you have identified yourself currently as a non-reporting entity and as such prepare special purpose financial statements. Depending on which alternative is adopted for Tier 2 and how much you currently voluntarily disclose, there will be some additional disclosures. Also, you will no longer be able to opt out of not preparing consolidated financial reports and equity accounting for your investments in associates and joint ventures. Again, the AASB proposals will not impact the recording requirements for trusts and other entities that are not currently required by legislation, deeds of constitution or otherwise to prepare financial statements in accordance with Australian accounting standards. It won't impact grandfathered proprietary companies nor impact the large and small test. The AASB intends this process to be truly consultative. It will be more than happy to receive your feedback. Please get involved. From KPMG's point of view, we believe that Treasury should also engage in this consultation process to determine which corporates are required to publicly report under the Corporations Act. Finally, remember that the specified disclosure requirements, as proposed by the AASB, still provide preparers with an element of determining what they disclose in their financial statements. It's not just the full freedom under the current Australian reporting entity concept.